Welcome to Investment Perspectives. I'm Shash Kachari and I'm joined by Wouter Struikenboom, one of our senior investment strategists, to talk about our 2016 Global Market Outlook. Wouter, thank you for joining us today.
Thanks, Shash.
Before we talk about 2016, it would be good to get a recap of 2015. What are some of your main observations of 2015 and how do they compare to the expectations of the team?
Yes, if we look back to 2015, I think our primary expectations largely played out. In particular, the fact that we didn't foresee markets moving much higher given the valuation overhang that we've had. And secondly, given the fact that volatility was going to be elevated.
Were there any key surprises?
I think the key surprise that we faced was the devaluation of the Chinese currency halfway into the year. That was definitely an event that caused more volatility than we anticipated. That, against the background of higher volatility in general, was still a surprise to us.
So one of the themes of 2015 was high volatility. Do you expect that to continue into 2016? And what other themes do you think will emerge?
Yes, we do. Volatility, we think, is here to stay. Just from the fact that the Fed has just started hiking interest rates and we don't know how quickly and how far they will go, we think will be a source of volatility. But on top of that, we have pretty high uncertainty around commodities and the emerging market growth story, with China in particular standing out. So yes, volatility, in our opinion, is here to stay. What we're concerned about is the feedback loop from the Fed to a stronger dollar to weak emerging market growth and currencies. So that feedback loop back to the US is what we're focused on. And although we don't quite yet know how it will play out, we do know there's a risk there of further emerging market weakness. So that is a particular topic that we're focused on, especially for the first quarter of 2016. After that, we think the market will have adjusted its expectations to such an extent that we'll get some more clarity. But for the first quarter, we really have to be careful with that feedback loop and the extent to which emerging markets could be negatively affected by the Fed hiking rates.
Let's turn our focus to how investors can potentially use our forecasts. You work very closely with our portfolio managers. Do you have a sense of how they're adapting their portfolios based on your forecasts?
Well, that's a good question. Looking at our interactions with the portfolio managers really are daily. We can say that they're picking up on three major themes from us. Firstly, of course, the fact that we're cautious and have a neutral overall risk allocation. That's something they're taking away. In fact, they're using that to make sure that their portfolios have some downside risk protection in them. Secondly, I think the theme of central bank divergence really shines through in their portfolios. So they really are picking up exposures to those asset classes that have a tailwind from the ECB and the Bank of Japan, while avoiding those that have a headwind, such as those in the US.
Okay, so looking at markets broadly, so what impact will this environment have on equities and growth assets more broadly versus fixed income?
Well, I think in general we have to be prepared for volatility, and therefore we have to have a slightly cautious bias to our investment portfolio and the risk we take in our investment portfolios. Looking at our process, we look at valuation, business cycle and sentiment, and at the moment it's pretty clear we have expensive valuations against the backdrop of slightly positive business cycle outlook for developed markets in particular. That tension is keeping us close to neutral, those contrarian signals. And if we can see a more positive feedback loop develop, we could also move to a slightly more positive allocation in our portfolios.
Drilling down into equities now, what comes top of mind in this environment for equities?
So obviously we want to be cautious and have a good eye on the volatility prospects that we have. So that's the first point I want to make. Volatility is something that we have to be prepared for and ready for within equity markets in particular. Secondly, I think we have to acknowledge the fact that correlations are likely to come down a little bit. The fact that central banks are diverging probably means that their trajectories of their equity markets will also diverge, and therefore correlations will come down. Which of course brings me to my final point. The fact that central banks are diverging, we think, will continue to be a major theme for our expected returns in different regions going forward. There really are opportunities in those regions that have a tailwind from central bank policies, but at the same time, we have to acknowledge there's also a headwind in those regions that don't have that.
So now, focusing on fixed income, we expect the returns from fixed income to be lower than equities in 2016 generally. Where are there potential opportunities to add value for investors in fixed income?
Well, I think in fixed income, just like in equities, we have to acknowledge the fact that central bank behavior is a major force. So here too, we want to have exposures to those regions with a central bank tailwind, the Eurozone and Japan, and we want to be cautious with the regions that have a headwind, like the US. Looking beyond government bonds, however, looking at credit markets, we do see some value starting to emerge, especially in the lower rated corporate bond segments, the so-called high yield segment. There we are now seeing the first signs of valuations reaching very attractive levels, and therefore giving us the opportunity to add some value by taking on some more exposure.
So what I'm sensing from what you're saying is 2016 is going to be very similar to 2015. Can you summarize in a few words the 2016 market outlook?
Indeed, the major themes of cautiousness, limited upside potential, and central bank divergence are exactly the same. So we're going to be driving those themes into 2016. However, after the first quarter, once we've seen the feedback loop from those first couple of Fed rate hikes, we'll be able to reassess our outlook in a bit more detail as to the rest of the year. However, as things currently stand, it's those three things that we'll be focusing on: volatility, cautiousness, central banks divergence.
Walter, thank you very much for your insights.
You're welcome.
They will help us plan for the year ahead. And thank you for joining us. We hope you can join us next time.